Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my September 14th energy update. In my August 10th energy update, I asked with prices above $4, was it too late to lock in pricing? And I explained why I believe it was not too late. In fact, it was more important than ever to lock in rates longer term. As you can see in this chart, anyone not already hedged who heeded my recommendation to take advantage of natural gas experiencing backwardation with forward market pricing from 2022 through 2025 trading near $3 and locked in prices long term avoided the consequences of the very large rally that took place since my last report. The timing of execution is the most important factor determining the effectiveness of hedges. In today's report, I will explain the consequences of not heeding my reports over the last 15 months by not hedging your gas and electricity contracts long term, and most importantly, what I recommend you do now if you have not hedged your gas or electricity or have contracts expiring within the next 18 months. To help you understand where we are today, in today's report, I'll be referencing several reports written over the last 15 months, starting with my June 16, 2020 energy update. In this report, I said natural gas pricing was consolidating at the lowest inflation-adjusted pricing since it began trading in 1990. Prices this low were below the cost of production, and companies producing natural gas won't generate profits, therefore the weaker companies won't survive. And the surviving companies would be highly motivated to decrease production, leading to higher pricing later on. The EIA was forecasting at that time that the average price for natural gas would be 50% higher in 2021, and I said based on what happened in the past when natural gas pricing declined to present levels, the EIA's estimates for 2021 may be conservative, and we could experience price spikes to at least $4, which is exactly what is taking place now. And as you can see, those who heeded my recommendation are paying much less now than where we are today. But as I said earlier, the timing of execution is the most important factor in determining the effectiveness of hedges. And my role as commodity analyst for energy professionals is to monitor markets and point out short-term opportunities to execute hedges. Which brings me to my September 14, 2020 report, which was written 1 year ago today. In my September 14, 2020 energy update, I said we had moved out of the consolidation pattern formed at the lowest inflation-adjusted pricing since 1990. Which are referred to as a buying zone, and pullbacks to this zone should be considered a buying opportunity for any unhedged accounts. At that time, I said my concern was if you delayed, you would likely pay much more later. And as you can see, those who took advantage of the pullback to the buy zone locked in their pricing at the lowest possible price, and those who didn't paid much more later. But those who did not lock in their natural gas and electricity rates in the fall of 2020 had another opportunity to do so at the lowest possible price this spring during the spring shoulder period, which I discussed in my April 12, 2021 energy update. In this report, I said it was not surprising natural gas didn't rally when demand was low in the spring shoulder period. But it was important to note prices were consolidating above long-term support near $2.50 and was forming a pattern similar to 2001, 2012, and 2016. Early in those bull markets, they formed patterns of higher highs and higher lows, and the average price was always higher for at least 3 years. And as you can see, those who took advantage of the pullback above long-term support avoided the large rally we have been experiencing ever since my April 12, 2021 energy update. Which brings me back to my last report written last month on August the 10th. In this report, I said the Biden administration, similar to the Obama administration, had increased fossil fuel regulations, which inhibits production, and in conjunction with the amount of spending proposed in most recent fiscal packages, this increases the risk of inflation in all areas of our economy. I also said it was highly unlikely we would return to the pricing experienced during the Trump administration from 2016 to 2020, when regulations were lifted and production increased to new records, and inflation was a non-factor. And I said that pricing north of $6.50 was definitely a possibility. In this report, I said the good news was pricing in the forward markets was still experiencing backwardization in 2022 to 2025, and pricing was near $3. And 3 years from now, you may look back and realize there was only one cost of doing business you could have stopped increasing, and that was your cost of energy for natural gas and electricity. As I've shown in my reports over the last 15 months, those who followed my recommendations and hedged their cost of natural gas and/or electricity long-term have secured effective hedges. But going forward, I will need to modify my recommendations according to your specific needs. After writing my August 10th energy update, natural gas pricing has greatly increased, and pricing in 2022 is not as attractive as it was last month. But as you can see, the forward market pricing from 2023 through 2025 is still trading near $3. Therefore, based on the shape of pricing in the forward markets, anyone who has not already hedged their cost of natural gas or electricity or have hedges expiring within 18 months, I recommend hedging your gas or electricity accounts according to the following three scenarios. First, anyone who has not already hedged their cost of electricity or natural gas, or their hedges expire within 18 months, I recommend executing hedges starting in 2023 and carry that forth through 2025. As I previously explained, the risk of inflation is very high, and I believe reserving energy for natural gas when it's near $3 is definitely in your best interest. Remember the old proverb, a bird in the hand is worth two in the bush. This is pertinent to ensuring budget certainty for 2023 through 2025, when inflation will likely be a great risk to your cost of doing business. Second, if you don't have hedges expiring within the next few months, wait for natural gas to pull back from its present rally, and then execute hedges through the end of 2022. When a market increases exponentially as it's presently doing, invariably there will be an equally sharp pullback sometime in the future. The timing of the pullback will depend on many factors, but the weather is often the primary trigger. If we have a cold winter, the decline may not come to pass until the spring of 2022, but it will come, and we will contact you when it is the time to execute your hedges through 2022. Third, if you have hedges expiring within the next few months, contact your energy professional's advisor, and they will advise you, depending on the state that you are in, whether it would be wise to wait or to lock in rates long-term immediately. For our clients who followed our recommendations over the last 15 months, today's report confirms they made a wise decision based on the facts I strive to present in my reports. But those who have not, or have hedges expiring within the next 18 months, hopefully the three scenarios that I presented in today's video will help you in securing your next natural gas and electricity hedge. And until my next report, please take care.